Hello and welcome everyone to this weekly market recap for the week ending January 17th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be with you all again this weekend. A couple of things to talk about before we get into the numbers. First of all, the most bullish period of the year ended on Friday. Just so you know, talk about it every year, but the most bullish period of the year for the S&P 500. This goes back 75 years. It begins at the close on October 27th, and it continues until the close on January 18th. Friday was January 17th, so that window is closed. It wasn't a huge period this year, but once again, it was higher. We finished higher on Friday than we began this period back on October the 28th or at the 27th at the close. And that makes it now 64 years out of the last 75 years that period went higher from start to finish. Doesn't mean it went up every day. It doesn't mean, we went up 5%. It just simply means we ended the period higher than we began for the 64th time in the last 75 years. One thing to take away is most of the time, or maybe put another way, rarely do we start a bear market during this 4-month period or three-month period, almost 3-month period. So that's number one to just keep in mind. Number two, we had a couple inflation reports out this past week, both of them rather benign. The PPI, it was the December core PPI that came out on Tuesday, and it showed that the PPI was flat. Core PPI was flat. Expectations were for a rise of 0.2%. No inflation in December at the producer level. On Wednesday, we got the December core CPI number. So that's inflation at the consumer level, which is more important, I think, well, definitely more important in my mind, and the impact it has on the stock market. But I think the Fed would probably agree that inflation at the consumer level is the more important reading. That was on Wednesday. We came in at 0.2% increase, but the market was expecting a 0.3% increase. So again, below expectations. All of a sudden, all the selling that we had seen in the market, or maybe just sideways consolidation in some areas, but a lot of areas we did see selling from the beginning of December all the way through, the prior week. And so it was about a 5-6 week period that was pretty challenging. All of that got reversed this past week with those Tame inflation reports. And as a result, our major indices went up. So to see how much, let's take a look at the action. S&P 400 mid-cap stocks led the action last week, gaining 4.53%. Russell 2000, that's your small cap index, gaining almost 4% on the week. Dow Jones kind of seemed like it was left for dead there for a while, bounced back 1,500 points or 3.7% on the week. Then we have transports gaining 3.19%. And then there was the S&P 500 and the NASDAQ, which actually trailed this past week. S&P 500 gaining 2.91%, NASDAQ 2.85%. As we move on to the sectors, energy, big pop in energy last week, gaining 6.3%. Crude oil had a nice week, and as a result, many of the energy names followed. Financials up 6.15%. I can tell you the banks, really just another solid week in that area. I'll be talking more about the banks later. Materials over 6%. So the energy, materials, and financial areas gaining over 6%. And remember, what was the S&P? Up 2.91? Yeah, 2.91%. So clearly, there were more value-oriented stocks. You could throw in industrials, real estate, utilities. So a lot of those areas were playing some catch-up to growth. Growth continued to hold up pretty well through December, but we did see value moving up. Growth went up too, by the way. I don't want to say that growth went down. I mean, we saw all 11 sectors up last week. So it was a wide participation move to the upside, and we were able to clear some pretty key moving average on our major indices in some of these sectors as well. So all in all, I thought it was a really good week. We had good news. We had good market reaction. The only downside, and again, I don't think it's huge downside, but just recognize that the most bullish period of the year historically has ended. And so now we're going to take a look and see how we can finish out the month of January, because the January effect has a pretty, I would say, has a very strong correlation to how the stock market performs over the last 11 months of the year. If January is strong, if January tends to, or turns out to be a really strong month, then we should expect the balance of the year to also be strong. That's what the January effect tells us. We'll be talking more about that as we get toward the end of the month and into early February. But that's something I'll be watching here over the next couple of weeks with earnings starting to come in, is how the market holds up. 10-year Treasury yield. This was one of the big things. Let's zero right in on this chart over here, because part of the problem in December and throughout early January was the 10-year Treasury yield kept going up. And part of that problem was there were a lot of folks out there thinking that it was inflation, that the Fed, that folks were getting out of bonds, selling bonds, sending the yield higher because of inflation expectations, another surge in inflation. I don't buy that, because I don't think the rest of the market is worried about inflation. We're not seeing it. We've seen the dollar do well. We've seen, areas that normally outperform when the market's worried about inflation, areas like real estate, gold. Those areas haven't really outperformed. Definitely not real estate. Gold's performed pretty decently, but not the kind of surge in gold that you would expect if you truly had an inflation problem. So anyhow, all this moved to the upside, and then once we got those Tame CPI reports this past week, everybody was back into bonds again, jumping into bonds, buying bonds, and bond prices higher, and the yields are always 100% opposite of the price direction of bonds. So when you see the yield coming down, that's telling you people are going into bonds. And that's important. If they're going into bonds and out of stocks, that can be a problem. But in this case, they were going into bonds and into stocks, which is the normal process when the economy is strong, when we're not worried about inflation. Generally speaking, the yield goes, it can vary. A lot of times we'll see money rotating out of bonds and into the stocks. When we really feel like the economy's strong and the S&P 500 profits are going to move upwards. Normally what you would see, the normal rotation would be to get out of bonds, which sends the yield higher, and get into stocks, which sends stocks higher. So they tend to go together. In this case, I think what was happening was a lot of folks were getting back into bonds simply because inflation is not the problem. Yields were not going up due to inflation. I believe the yields were going up because of the strong jobs report that we got, the fact that our economy remains resilient. These yields on the 10-year Treasury yield, even though they seem like they're really high, historically they're still low. That's what a lot of folks don't get. If you don't use long-term perspective, you think that these yields are just crazy and then mortgage rates are just outrageous. Not really the case. I think the economy can still thrive in an environment where the 10-year Treasury yield's above 4%, between 4 and 5%, and mortgage rates are at 7%. We may not see the screaming prices to the upside in home prices, but I still believe that can be an environment where the stock market thrives. S&P 500 in this kind of downtrend channel, but it looked like the action on Friday back above both moving averages. This is what I was talking about earlier, where a lot of our major indices are starting to show improvement, getting back above those moving averages. Take a look here at what's going on with the S&P 500 as we zero in. Big move back up through both the 20 and the 50-day moving average. We've had a little bit of price resistance right around this 6,000 level. So we'll see if we can continue this into this upcoming week. But it looks like the downtrend line's been broken. We're back up above the moving averages. So that tells me more that this is consolidation, not a downtrend. That's really important. That's what I'm taking out of this. A downtrend, usually what you would do is go up to the 20-day moving average, fail, and go back down to a new low. In this case, we keep going back up above the moving averages. We have established new lows, but this is not acting like a downtrend. We're not seeing the sellers pick back up again when we get close to moving averages. Instead, the market's just going, the major indices are going right back through these key areas. That's important to realize. NASDAQ 100, same thing, back above the moving averages. Looks like it may have broken this downtrend line, which for me is pretty important because I see a bullish wedge here on the NASDAQ 100. I see this line going down, this line also going down, but maybe squeezing just a little bit, kind of looking a little bit more like a slice of pie. And off of an uptrend, that's a bullish wedge. And it's a bullish confirmation when you break out of that or break above that upper downtrend line. And that's what I'm seeing here. Moving on to the IWM. IWM is at a major, major level. I like what's going on here, but this week's going to play a big role here as we look forward. You can see this pivot area on the chart as I pull this up. July, couldn't get through 226, 227. October, again, stymied at that 227 level. Then with the election results, we gapped up above that key area, pulled back essentially right to that pivot area at 226, 227, rebounded, failed on the new breakout. That was late November. That's when we saw a lot of the selling kick in small caps. We broke below the 226. That's horrible, except we've held on to the prior lows. I talked about 214, 215 being the key low. That is exactly where we turned back to the upside. And now we're threatening that 226, 227 area again. And we're doing it right now above the 20-day moving average. Bad things take place below the 20-day moving average. Good things take place when you're above the 20-day moving average. So this is at least the first step to repair the chart here on the IWM. So I like the action from last week. We'll see if we get continued follow through in the upcoming week. Transports. Transports seemed like they were left for dead, and they also had some key support from back in September and October, right around that 15,750 level. We bounced off of it several times. I mean, 5 times probably. Back through the 20-day moving average. Initial step. That's an initial positive step. Not out of the woods. This certainly, you could look at this and say this is still maybe a bear flag. You might watch this gap. This was gap support until we went through it in mid-December. Now it's gap resistance at 16,750. And notice the 50-day moving average is at 16,728. So I think that's if you're in the bullish camp, watch that rising 20-day moving average. That should provide you your support. I think 16,250 also provides some price support as well. All right, moving on. How about the Mag 7? So let's take a look at these stocks and where we sit right now, because many of them will be reporting earnings coming up soon. Apple, big move up in the AD line, which I think is really nice, considering that the stock price has been beaten up for the last few weeks. Apple, relative to the computer hardware group, was at a 52-week high at the end of December when their quarter ended. I'm expecting a big report. I think that this pullback's an opportunity in Apple, just my opinion. See what happens. Next up is Microsoft. Microsoft, another one with the AD line kind of hanging in there pretty good. We went down, we went up in December, came crashing back down the second half of December, early January, but I think we're back on a move to the upside. We still have this uptrend in play, dating back really all the way throughout the year. We had a double bottom at the 387.5 level, and we haven't taken out that high in between. So you could certainly argue, I guess, that we're in this trading range, but I'm seeing rising lows, which I think is going to lead to higher prices on Microsoft. NVIDIA, semiconductors were the top performing industry group on Friday. NVIDIA's given us a lot of head fakes recently, but we did hold on to the recent price support down just below the 130 level, and we are starting to trend back up. We closed back above the 20-day moving average for the first time in about a week on Friday. So we'll see if NVIDIA can build on that strength next week. Meta kind of going sideways with its AD line, still in this uptrend though. And overall, well, relative strength has deteriorated somewhat in Meta versus its internet peers. Volume trends though have gone higher on this last move to the upside. So I'm seeing mixed picture here with Meta as we get closer to earnings. We've got the clear price resistance just above 630. I think we've got some pretty good price support around 580. We're sitting kind of in the middle right now at 613. Which way, does this break? Probably going to find out with earnings. This one to me, I'm going to say I'd be about 65-35 bullish on Meta. I don't like the relative strength topping all the way back at the beginning of the quarter and then moving lower throughout the quarter. So Meta, I don't know. We'll see how that comes out. But that would be one that I would be maybe a little less confident about going into its earnings report. Another Mag 7 stock in that internet space is Google. AD line been strengthening of late. I see a really nice ascending triangle here. Big move up, equal highs, failure at about the 197.5 to 200 area. So we know what the target is to the upside. Got to get through 200. But I see these rising lows. This looks like a really strong bull flag, ascending triangle. Whatever pattern you consider is probably going to be bullish. Relative strength just recently at the end of their quarter hit about a 4 or 5 month high. So this one's kind of going in the opposite direction of Meta. So we'll see whether or not Google comes out with a good report. But I kind of like this. I think it's setting up for a breakout with earnings, if not before. All right, let's see what else we got. Amazon, look at the AD line here, just strong. I'll tell you what, I love the longer term chart here on Amazon. If we go back 5 years, you can see the tops in 2021. We struggled coming out of the bear market, went back up, broke out above the double top in the middle of 2024. One last pullback in early August when the Fed disappointed as usual, and then back up to new highs. So we're trending higher in all-time high territory on Amazon. And if we look at the relative strength versus broadline retail, that's been building as well. I like Amazon here. Finally, Tesla. Tesla kind of went through a surge that we saw. AD line was very, very strong. It pulled back. AD line pulled back a little bit, but it does look like Tesla's trying to regain its footing again. After dropping to 380, it's gone back up into the 400s. And you can see on a relative basis, it was just smoking to the upside in the fourth quarter. I think we're going to see a big report out of Tesla. So we'll see. So Meta is the one that to me is maybe just a little bit worrisome. Maybe throw Microsoft in that picture as well, because look at the relative strength in Microsoft. It did start to pick up in December and into early January, but that relative strength versus software has been a little weak. So I think maybe Microsoft and Meta would be the two that I'd be maybe just a little bit more cautious about. I really like Google. I like Tesla a lot. I think Apple is going to surprise to the upside. I think those are three of the Mag 7 that look pretty good. All right, let's take a look at the our website, EarningsBeats.com. If you go here, you can check it out. We've got a 30-day no-cost trial. We'd love to have you try our service. You will be notified before your 30-day trial is up. We're not just going to hope you forget about it. We don't want you to be a member if you don't like our service. I think our service sets up for a lot of folks. We've got a lot of testimonials, folks that have been with us for a long time, about our guidance, our research, the education we provide. It's top-notch. Check it out if you haven't already. Also, I talked about the Bowley trend a little bit, the historical analysis of the S&P 500 at the beginning of the show, saying we're ending a bullish period right now, or ending the most bullish period of the year. But this gives you so many facts. If you click on that link, it will bring you over here to talk about some of the things that you need to be aware of as a trader or even as an investor, knowing some of the best times to be using your capital to get into stocks. End of October, the last 14 bear markets, 7 of them, 7 ended in the month of October. And your moves out of bear markets, those are the strongest moves you're ever going to see in the market. So this kind of historical information is so important to staying ahead of Wall Street. So, but just check out these bullets, some of the things you're going to learn for free while I get some water. So Gonna let for free. This is 75 years worth of analysis on an Excel spreadsheet. We're going to give you for free many of the results of all of our research and work. How the S&P 500 performs on average each calendar day. You might think that, hey, doesn't really matter. You might be surprised. Go away in May. I write about it every year as we're going into May. It's a myth. I mean, in theory, May to October is not as strong as November to April. So if that's all you're basing it on, then okay. Yes, May is go away if you're looking at relative performance. But there are strong periods after we hit the month of May throughout the summer that you need to be aware of, and you need to know when the real go away in period is. It's not May. And then this is the biggest one of all. Which 12 consecutive calendar days, that's 38% of the calendar month. These are the same 12 consecutive days every month of every year since 1950. Which 12 consecutive calendar days have produced over 80% of market gains? If you can't answer that question, you better put your name and email address in here. Click that free Bowley Trend Part 1 report. We give this stuff away to try and give back to the community, help people invest better, invest smarter, trade smarter. I can't go in your computer and push the button for you, but I'm doing everything else. So just put your name and email address in there and join us at over at EarningsBeats. Join our community and get a really awesome report for free. Speaking of free, I also write articles over at Stock Charts, and I wrote one on Saturday, yesterday, and I want to take you show you how you can get there. Just click on that articles tab there at the top, and I was the last one to write an article, so you can see my article here talking about one group that has shown the most consistent relative strength for the past year. And it's one I've been talking about for the last year that was going to outperform when rates started to drop. But the other way, if you come in here on articles, you don't see my article over here, there's a drop down menu. Just go all the way down near the bottom, Trading Places with Tom Bowley. Click on that. And when you click on the article, I want you to look over here, follow this blog. This is another really important thing. This is a free, I do this at Stock Charts for free. And if you subscribe, this is a subscription over at Stock Charts, a free subscription to my blog. If you type in your email, hit that submit button, as soon as I publish an article, it will go to your email. So you won't miss any of my articles. You'll get them very timely through this free service that Stock Charts provides. I think it's a great service, whether it's me, whether it's Julius, Dave Keller, whoever you follow over at Stock Charts. There's this follow this blog email, and it's a really cool service. Put your email in there, and then you don't have to keep coming back looking to see if articles have been posted. They're going to be sent directly to you. All right, in this article, I talked about banks. I don't know if you looked at the earnings last week, but man, bank earnings were strong. You don't expect this out of bank earnings. I mean, normally, maybe out of AI stocks, you expect these big earnings beats. Look at JP Morgan. JP Morgan thinks it's an AI stock. 481 in earnings versus 403. That is a massive beat for a bank stock. Bank earnings are generally somewhat predictable. I mean, there are some things, especially with interest rates, that can impact quite a bit. They trade a lot. Some of these large money center banks will trade. So a lot of, the way the markets are performing can have a big impact. But all 12 of these stocks that I show right here, they're all banks that reported last week. All 12 beat the heck out of consensus estimates. And folks, I talked about this last year at Market Vision 2024, that when rates started coming down, when the Fed started lowering the Fed funds rate, that it had nothing, that has nothing but good things for banks, because their net interest margin will begin to expand. And the fact that the 10-year Treasury yield has been moving up is just a bonus. That spread is widening and widening. Their profits are moving up exponentially. And this is showing it. This is the after effect. But we just uninverted on the yield curve. I want you to look at the chart that I showed in this article. I made it a little bit bigger here and annotated so that you can see it. But here's the bank index. This was going back, when we got that July or June CPI report, that was when Wall Street started moving into interest sensitive areas, more interest sensitive areas, because Wall Street knew what was coming. They knew the 10-year Treasury would go up with a strengthening economy because rates were being lowered to strengthen the economy. So you got a win-win. Short-term rates, which is what banks use to borrow, they borrow at those rates. Those rates are coming down. They lend on the long end of the curve, which is like the 10-year Treasury yield, which has been going up. Well, if your borrowing costs are going down and your lending income are going up, that's how you get JP Morgan coming out with a massive beat in earnings. So check this out. Look at the banks outperforming here, or performing, moving higher. Down here, you can see the AD line being accumulated. Further down, here's the bank index relative to the S&P 500. Once the Fed started lowering rates, forget about talking about lowering rates. When they started lowering rates, look at the banks relative to the S&P 500. Just absolutely scorching to the upside. Look what's been going on with this uninverted yield curve over the last 3 or 4 months. It is now uninverted. I don't know if that's a word or not, but I'm using it. But now we're positive. This is literally a windfall for banks. And so I don't think this bank run is over yet. In fact, I was looking at the regional banks, and they haven't really done what the bigger banks have done, which is kind of surprising to me. I think this is a group that's going to explode to the upside. Since June, since that CPI report came out in early July right here, I mean, you can see the relative strength of this group. We've had pullbacks. I mean, we went up, pull back, went up, pull back. I think we're going up again. So we'll see how this all plays out, but I really like the banking area. I've been talking about it for a while. Nothing has changed. I think rates are going to continue to come down, and that's why we saw the banks do as well as we did last week. Because when those two inflation reports came in benign, that's stoking the fire for more rate cuts. So anyway, JP Morgan, big breakout on Friday, or actually it was last Wednesday. So with the inflation, with the CPI data coming out, Treasury yields starting to roll over, knowing that this is opening the door for further rate cuts down the road on the Fed funds rate, we saw JP Morgan break out. Look at the bullish momentum start to accelerate back to the upside. If you scroll down, great volume trends, price volume, nothing beats price volume in the market. You can look at anything else you want to, I don't care. When you are breaking out to all-time highs and you're doing it on heavy volume, save me the trouble of having to listen to all the other arguments. This is bullish price action, and we already know the bullish fundamentals are out there. Really, really good action here. There's the AD line. Here's JP Morgan up 59, almost 60% now over the last 12 months. JP Morgan leading the banks to the upside, banks leading the S&P to the upside. This right here, folks, this is how you beat the S&P 500. If I go back over to EarningsBeats and scroll down and we take a look at historical performance, look at the model portfolio of this last quarter, up almost 10%. The S&P 500 over the last quarter, and this quarter, by the way, started back November 19th. So it's not since the beginning of this quarter. I'm not talking about calendar quarter. But since November 19th, our model portfolio is up 10%. The S&P is up 1.35%. Why? Well, I can tell you one reason why. JP Morgan's in it. Because JP Morgan is a leading bank, and we love the banks. So the way you beat the S&P 500 is with leading stocks in leading industry groups. That's it. That's the magic formula. Look at our performance since 2018. Model portfolio up 289.04, 289%. S&P over the same period up 123%. That's over 6 years now. I mean, of all the things we've done at EarningsBeats, this is probably one of the proudest feelings that I have, is just showing folks how you can beat the S&P 500. Returns like this, you don't understand unless you start putting down numbers. If you invested $100,000 on November 19th, 2018, it would grow to 222,000 on the S&P 500. In our model portfolio, it would grow to 389,000. The trajectory, instead of seeing this, you see this. And it makes a huge difference long term. That's why we do everything we do. It's about education, it's about research, market guidance, and then literally having portfolios to show you how you can beat the S&P 500. Sign up at least for our trial, the Bowley trend, start to learn more, become a better trader in 2025. All right, last thing I want to do is show you the industry groups. I wanted to show you here, this is the performance from Friday. So the performance from Friday, you can see semiconductors were leading. I want you to look at banks right here. Number 10, there's 104 industry groups. Banks were number 10. Let's go to the last week, 1 week. And this was something I talked about in that article on Saturday as well. So over the last week, aluminum has been leading. Look down here, just kind of lurking. Banks. What's this? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 10th on Friday, 10th best industry group on Friday, 13th best out of 104 over the last week. Let's go out a month. Look at where banks are over the last month. They're in 7th place out of 104. Oops, wrong. That is not what I wanted. Sorry about that. So we did the month. Let's do 3 months. There's banks. 5, 8, number 11. So far we've had 10, 13, 7, and 11 in the top, those numbers out of 104. Let's go back 6 months. And there they are. Banks. 1, 2, I think this is exactly 20. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Banks are 20th out of 104 over the last 6 months. And then 1 year, banks are 8th. This is the only industry group that is in the top 20 in all 6 of those periods. That's how consistent the strength has been. So that's what I was writing about in this article. Only one group has shown consistent relative strength for the past year. It's the banks. And it's something we've been talking about. I audited banks prior to starting EarningsBeats. I was a former practicing CPA. I audited banks. That was part of my responsibility. I was in public accounting for 20 years. If I know one group really well, it's the banks. They're not going to stop. They're going higher. Now, will they continue to outperform the S&P 500? At some point, they will start to just go along with the S&P 500, which is still awesome because right now they're pricing in. The reason they're outperforming is they're pricing in future growth that nobody saw coming other than maybe EarningsBeats subscribers because we've been talking about it. Anyhow, last thing, I know I said that was last thing. Last thing, let's talk about a few companies reporting earnings this week. Netflix will report on Tuesday after the bell. I think the stock looks pretty good. AD line was climbing throughout the last quarter. Relative strength, I would have rather seen this in December rather than November, but that was a lot of relative strength in November. We pulled back. I'm going to be interested to see what happens. We started to turn back up last week. I think one of two things, I'd watch for one of two things when they report earnings. If we gap up, which I think is more than 50-50, maybe more like 60-40 or maybe even 65-35. If we get the big gap up, if we open above 940, that would be very bullish for Netflix. The other side would be as if we open below this recent low. If we were to open below 815, 820, that's going to make me a little bit more nervous about Netflix in the near term. But I think it's setting up for a gap up. We'll see. Next up, Johnson & Johnson will be reporting. Johnson & Johnson just went down, hit a major support area at 191, or excuse me, 141. That was the level it was at in April, just went down there, rebounded here. But I mean, the relative strength in the group, the pharmas, 52-week low. And this one's just been kind of choppy. I don't know. It's made a little bit of a bounce. I'm a little worried about Johnson & Johnson. I mean, it's a staple stock, actually healthcare stock. So it's definitely going to be a stock that um, you're not going to see. It's not an AI stock. It's not a quantum stock. You're not going to see that kind of movement in either direction. I just don't know if now is the time yet to get into Johnson & Johnson. Got to see a little bit more. One other company that will be reporting, this is another company in our model portfolio. Check out what's been going on. They actually gave a preliminary report last week. And in that preliminary report, you can see the reaction. Market loved it. AD line setting new highs. And once again, relative strength. This is how you beat the S&P 500 by going with leaders. CSX I'm watching. That'll be on Thursday. And I'm watching that one because of the transports. AD line's not been good. Price action is another double bottom here, similar to J&J, except this one we have gotten back through the 20-day. I don't remember if J&J was through the 20-day or not, or if that was the, let me look at it real quick. J&J, yeah, it did go through the 20. It's between the 20 and the 50, similar to CSX. But I'm hoping that CSX has some good things to say about the improving economy ahead. So I don't know that their report's going to be strong, but they may have some better news. Anyway, I would just watch it. I would not hold this into earnings, but it's one I am watching from this week. And then on Friday, American Express. Look at the AD line here, strong. Price action, strong. Relative strength versus consumer finance, 52-week high. Consumer finance relative to the S&P 500, 52-week high. American Express, a leading stock in a leading industry group. Can't say this enough and emphasize it enough. If I was going to hold a stock into earnings, it would be one like American Express, especially seeing how the financial stocks were treated this last week with earnings. I like AXP this Friday. All right, one last thing. Another one last thing. This is my third last thing. Tomorrow or Tuesday in the EB Digest, I'm going to show you a leading stock in another leading industry group that reports earnings coming up pretty soon. If you're not already an EarningsBeats Digest subscriber, now is the time. If you go into our homepage, you can simply scroll down, and right here, there is a place. Actually, if you sign up for the Bowley trend, you'll automatically go into our EarningsBeats Digest. But if you don't sign up and you're not already a Digest subscriber, it's really simple. Name, email address, no credit card required. You can unsubscribe at any time. These come out usually Monday and Wednesday, but because Monday is a holiday, Martin Luther King Day, markets are closed, we're going to send out our EB Digest on Tuesday and Wednesday this week. So sign up now. Make sure you get that leading stock. I mean, this is how you outperform. I'm going to give you another one for free on Tuesday, so check it out. Anyhow, that's it for me. I really appreciate everybody tuning in. We went a little longer today, but I had a number of things I really wanted to talk about. So hopefully that helps as you go into a new holiday shortened week ahead and as we move out of the most bullish period of the year historically. Have a great rest of your weekend, everybody. Happy trading.